Keeping it real in trading means staying grounded and realistic about the challenges and risks involved. It's about maintaining a clear-eyed perspective and avoiding the pitfalls of overconfidence or irrational exuberance. Let's explore how risk awareness and humility play pivotal roles in this approach. Risk awareness in trading. Understanding risk. Recognizing that markets can be unpredictable and volatile. Being aware of this helps traders prepare for sudden changes and potential losses, knowing how much capital is at risk in each trade and the potential impact on your overall portfolio. Calculating risk-reward ratios. Before entering a trade, evaluate the potential reward relative to the risk. A common approach is to aim for a risk-reward ratio of at least 1 to 2. Use stop-loss orders to limit potential losses. This is a practical way to manage risk and protect your trading capital. Diversification. Diversify your investments across different assets, sectors, or markets. This reduces the impact of a loss in any single position. Ensure that you're not overly invested in one particular trade or market segment. Constant vigilance. Regularly review your open positions and market conditions. Staying vigilant helps in making timely adjustments to mitigate risk. Keep up with market news, economic indicators, and global events that could impact your trades. Humility in trading. Accepting mistakes. Humble traders view mistakes and losses as learning opportunities. They analyze what went wrong and use this knowledge to improve their future trades. Instead of blaming the market or external factors for losses, humble traders take responsibility for their decisions. Continuous learning. Humility involves recognizing that there's always more to learn. Successful traders continually educate themselves and adapt to new information and techniques. Being open to feedback from mentors, peers, or other experienced traders can provide valuable insights and improve your trading strategies. Realistic expectations. Humble traders set realistic goals and understand that overnight success is rare. They focus on gradual, consistent progress rather than aiming for unrealistic gains. Markets are influenced by countless factors, many of which are beyond a trader's control. Humility means acknowledging this uncertainty and preparing accordingly. Keeping ego in check. Success in trading can sometimes lead to overconfidence. Humble traders remain grounded and avoid taking excessive risks based on past successes. They strive for a balanced approach, neither getting too euphoric during winning streaks nor too despondent during losses. By cultivating risk awareness and humility, traders can maintain a realistic and disciplined approach to the markets. These traits help in making informed decisions, managing emotions, and ultimately achieving long-term success.